Right, so stock started the week on a really strong note after Friday's doji pattern coming out of the trade deal news. I'm going to break down what these technical signs now mean, this little breakout means, and what patterns are developing, especially on the market forecast chart, and what that could mean going into the holidays and into the end of the year. I'm also going to break down our expectations of how much longer this bullish run can last, and kind of contend a little bit with this idea that we might be entering a euphoric phase of the market similar to January of 18. And we'll take a look at that with our trade idea for a stock that's breaking out of a long inverse head and shoulders pattern and giving us an opportunity. So let's go ahead and get started. Today is Monday, December the 16th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast on the S&P 500 first. You notice we got three lines above 80, including the near-term line getting back above 80 here. But what's interesting is that the near-term line, the blue line, is still below this near-term high. In fact, it's been progressively lower. These last two peaks have been progressively lower. If this ends up being a peak, all right, obviously it can keep going up. But the S&P itself is already well higher compared to where we were. In fact, now it's moving up so much that the 23% Fibonacci line is getting into the area of the low point that corresponds with that near-term low that's in between. So this is something to keep our eyes on, again, especially as we are going into now starting month number three of this intermediate run that's typically 1 to 3 months long. If you take a look at the Russell 2000, you notice the near-term line has not come up as much, even though we keep going higher on the Russell, but we keep getting longer upper shadows here. So a little bit of that's what's keeping the near-term line down without it popping back up. We still have a strong bullish posture. Market sentiment still rising, not above 80, not quite yet. You can see the NASDAQ is showing the same divergence pattern. 8,600 would be that target. And then the Dow Jones Industrial Average would also, it's not above 80, and it's got the same thing, these longer upper shadows. You know, again, this short-term red flags, nothing serious, nothing significant. In fact, you'll see with our trade idea today, we're pretty bullish on that trade idea. But you'll also see in some of the trades that we'll do, that we have done, that we've kept them rather minimal in terms of position sizing because of this. We're still bullish following the trend. But we manage our risk accordingly. And this would be, these red flags would be the reasons why. So I were to come back to the S&P 500, if I were to kind of zoom out a little bit so you can kind of see the idea here. And you can see, again, we are just gradually moving up on this intermediate run. And I've been drawing the Fibonacci lines as we go. For any kind of where support would be on any kind of pullback here. And so we're not surprised if there is any. You'll notice that we're never surprised when we get these types of moves because we draw lines and we see on the on the Bollinger Bands. In fact, if I come over here to the Bollinger Bands, you can see, you know, where the resistance would be. In fact, here let me put on the Bollinger Bands on this chart so you can see it better. And well, I have to leave it on the 1-year chart. Let's do the Fibonacci lines from this low point here all the way up to the high point. Oops. So you can see that the 38%, 50% retracement levels are starting to get down into where the volume nodes are. And if I were to throw on here, let's get rid of this one because it's not as relevant anymore. If I were to also edit this and throw on this chart, we're going to make it a dotted line so it stands out a little bit. There's some volume support. There's a node in this 309 area, 312 first, and then 309 down below it as well. So we continue. In fact, look, 3 days in a row that we've been above the upper Bollinger Band with a very low bandwidth that's now rising. If you take a look at the DMI for the S&P 500, its positive directional index has gotten up to above 40 for the first time in the last 52 weeks. The last time we had that here, and you can see the divergence that started after that, right? That took a while. It took a few weeks before we got the big pop above 40 that set the low point. Usually that kind of sets a low point. You can see one over here as well. when the negative directional index gets above 80. Sorry, I feel like I'm popping down to the bottom of the screen here. But we do have the average directional index already above 20, so we are in a trending state with the negative index dropping back below 20. But you can also see too, again, you know, it would be the same kind of divergence where you're getting higher lows with higher highs. It should be lower highs if we're getting higher lows here. So it's kind of an interesting pattern, because that's more that the fact that we're not down as much means that we're more negative. Or less, more negative, more positive on the blue line, more negative on the purple line because of the higher low. And obviously we're not more negative because we've gone up to a higher high. So same thing with the near-term line, and again, just simply a small, short-term at worst, red flag on that chart. The last thing I wanted to show here was the Ichimoku cloud. You can see how far up above, and we are well up above strong trending areas. You don't fall off a cliff from strong trending areas. Here's the last time we were strong trending, and then we fell off that cliff right there on the indicator, and that's about all we pulled back there, barely below the blue line. We got below the blue line on above the cloud and hovered around there for a while before we got more of an intermediate pullback. So we're not looking for any kind of falling off a cliff anytime soon on the S&P. In fact, if you look at the weekly chart, it's also strongly bullish, and the weekly chart over here we were strongly bullish for months. A few little occasional blips, neither one of them got below the blue line. We're so far up the blue line right now that we're not anywhere close. And by the time we got over here in January, where a lot of people are saying this, we're as euphoric now. I'll talk about this more later in the video. We're as euphoric now as we were back in January. Well, if I were to throw on a log scale here, now it doesn't look nearly as euphoric, not nearly as far up above as we were over here, number one. And number two, you can see we're not nearly as high on the trend quality and trend noise balance as we are right now. The trend quality is just barely getting above 9. So it just kind of again shows us how strongly bullish we are. Kind of watching the market forecast signal on the weekly chart too, since that brings it up, and you see the momentum line pulling back, but the near-term line has been up here for quite a while, getting those two back-to-back clusters there. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, you want us to do it again tomorrow. It's our survey. You can answer with one click if you like us to do these videos. If you don't want us to do these videos anymore, let us know by not clicking down there. And also, while you're down there, comment. What did you get out of the video? What comments, what reactions do you have about anything I talked about? You can put down there in the comment section. You can also reply to other people's comments too. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe for free to be able to access our forum, our community on our site for Market Outlook viewers. Specifically for Market Outlook viewers, as well as our market commentary section of our blog, webinars and different things that we do. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. Alright, if you're watching this on our blog, I invite you to check out these other things that are on the page, including our classes that we have, our upcoming classes that we have. Remember, you get access to all of our trading rooms. We do 8 a week. You get access to those in their archives with our monthly subscription plan. You can click on this link. That will give you more information on that, as well as up here, just click on the plus. That's a good way. It's $99 a month to check us out. Most of our clients are our premium clients, in which you get access to all those, plus a couple more Q&A sessions every week, and then all of our custom content, scripts, scans, investing plans, everything. We also invite you to engage with us on social media. Down here at the bottom, you'll see the Market Outlook tweet, Market Outlook Facebook post. Just click on this heart that opens up this new window. You can click on like, hit this thumbs up. That takes you to your Facebook page. Again, the more you engage with those tweets or those posts there, the more likely Twitter and Facebook will continue to promote our content in your timelines. Again, they promote content that you engage with, so we try to make it really easy for you to do that here. All right, if we take a look now at the weekly chart, you can see that we got a pretty good, it's only one day into the week, but so far we got a pretty good weekly candle here, closing above last week's high point, the actual high of the week, with this week's Heikin-Ashi close. Now, the Heikin-Ashi close is the average of 4 prices, so we still got, a close and a high, for that matter, and a low that we could produce this week. The open set, all right, so those 3 things. But you can see from the PPO down there at the bottom, just to kind of give you some context again, comparing back to that early 2018 level, that's where we were at in early 2018. We were well above the PPO. We're high. We've been higher in the past and other levels, and you can see over here in 2010, for example, we were above the same level in the PPO for months, and same thing really in 2013 and 14. Now this was QE fuel. Both of these actually were QE fuel. QE2 right here, QE1, QE2, QE3. And this is the tax reform fueling. And this could very well be a trade issue fueling. We didn't quite get one of those coming off of this death cross. We didn't quite get high enough until the tax reform. But now that we have a trade deal, that might be what sparks more of a long-term, multiple weeks for a few months, a strong bullish posture here with the momentum very, very strong. Again, it looks more parabolic than it is when you look at it on a log scale. You can see not nearly as parabolic as what we saw in 2018, because we're just barely getting going. Again, I've compared the clusters that we've gotten to the early part of 2017, kind of this area right here where we got some clusters and a little bit of weakness before we continued the trend higher, and we were just barely at this same level in the PPO at that same time. So very similar patterns there. Looking at the 3 green arrows here, let's pull up SPX. You can see that we have 3 green arrows, obviously, and if you look at the MACD for those same 3 green arrows on SPX, you can, whoops, excuse me, I need to get to this line, this chart. If you look at the 2 lines, you can see just how far above the 8-day moving average we are. The MACD is pretty darn high. The stochastics is up here. In fact, if I were to change that MACD here, whoops, not that one. If I were to change that MACD to show how far the price is right now above the 8-day moving average, which measures really, really short-term momentum, right? To pull away from the moving average that far. Here, let's just take a look. We won't put on the average. We'll just look at the blue line. So again, this line represents how far above the 8-day moving average we are. And again, to kind of give you some context here, it's what, 35.69 points. Let's edit that and go to 35.69. Hit OK. So you can see right about where we're at right now. There's we got that far up above here, and we kind of went sideways for a few days. Over here, we got some high. We continue to go higher. On that one, that was at the initial surge off of that low, and that was also an initial surge off of this, off of that intermediate low point. If I were to go out, I can't go out too far because MACD is an absolute level. It's not an apples to apples comparison when you start looking at different prices. But you can kind of see this is a pretty high level to be above the 8-day moving average. It doesn't necessarily mean that we'll stop, as you can see. But most of these kind of start surges. They start intermediate runs. Again, a lot of people look at this over here because this ended when we got this far above the 8-day. It ended at intermediate run, whereas like I said, all the rest of these kind of start them. So here we are. We haven't we started the intermediate rally with this peak above 4, and we were diverging just like normal. You start getting lower highs. It's look here. You can see it's very typical to get lower highs as you converge. Same thing here. See the trend of the highs above the 8-day moving average. It's hard to get going once you get the intermediate surge. It's hard to get going too far up above these levels. Same thing over here. So we were doing the same pattern until we broke out here. So this could very well be kind of a secondary surge. I think that there will be some weakness here, not too major, but we could get a secondary surge coming out of this that could last about the same time as this first surge lasted on this particular intermediate run. If you look at the volume, the intraday volume, here we are on the intraday volume here, you can see, or the intraday move, you can see the gap up that we had. So it opens up a little bit of a volume gap here below where we're at. And again, I wouldn't necessarily consider that a breakaway gap, considering we're not breaking out above anything, and there's no bump in volume. We already had the bump in volume. Volume's actually tapering, even though it was relatively high today. When you look at it on a daily chart, you can see, well, it doesn't show there, so I have to go to this chart here. If you look at today's volume, it was, again, kind of a third consecutive day of some decent volume. But you notice here a lot of this volume was adding on to the prior day. If I were to look at this pattern, where'd it go? Right here, then I would venture to guess that tomorrow's volume is not going to be nearly as high. So, kind of primed to break that gap, but nothing more. I mean, like a move to 317 wouldn't be a big deal, right? And then there's your 312, 313 area. And then there's the point of control now, which is at the 319, and will be for a while, because this low is not moving anywhere anytime soon, and we might move up to high as we push up towards that 324 level. Now let's take a look here at we saw the volume. The trading range so the volume was above average 1.5 times. The trading range is also above average. So if you look at this chart, this one right here, you can see that we're starting to creep up a little bit. Now, not to the point where we're any concern at all, because again, 1% is 3 points. So as long as we get moves below 3.2 points, essentially, nothing to concern about. But there's a little bit of a bump up, and while it didn't happen today, with volatility dropping to extreme lows as it did, that sets up the possibility for us to boom. Very, very oversold in the volatility levels as we drop back down just like that to the 80% level. In fact, this is what it looks like on the daily chart, getting as low as we did on the intraday basis, below that 80% before bouncing back up. So just like that, I mean, we got a couple little bounce up, and the nice thing about that bounce for the month of December is it gives us a pretty decent range. We got a 6-point range, which is a little bit closer to the average compared to last month, where it's only 2.75, which sets up for the possibility of a bigger volatility jump that we had. But so far so good in terms of only getting the 18, but still providing a pretty decent range for December, that we could follow up in January with similar type range without going haywire. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click that link. It opens up a poll. You can hit either agree or disagree. If you click disagree, comment down below on what you're seeing that makes you either more bearish than I am, or more bullish. Obviously, everybody's got their opinions, and you can share your opinions, but also share what's driving that opinion, because that's the valuable information that would be good to share, so that our community has different viewpoints there. All right, now let's take a look at what's driving the price action here. And one of the things I tweeted out actually earlier today is this chart. If you look at this chart I just barely showed you, this is that same chart on a 1-year basis heading into the October low point that this intermediate run started at, on that October 8th low point. This is the returns of different asset classes going into that low for the 1 year. You can see crude oil was down 30% going into there. At least the ETF was down 30%. Small cap stocks were down 10%. S&P was flat on a 1-year basis. You can see the dollar was up 6% right here. Real estate was up over 15%, and gold and long-term bonds were both up over 25%. I mean, you look at those and you think, man, this must have been a really bearish market. And the reality was we did have a big dip here last Q4, and then we bounced up, and a little bit of a pullback in May and another pullback here in August. But the reality is, since then, the market was relatively flat. It wasn't bearish at all. Not to the tune of 25%, 15%, and all these safe haven asset classes, with the dollar outperforming high yield and equities and international and small caps, and of course crude oil. And even if you just look at the 6-month returns, you have over 15% returns in long-term bonds and gold, and real estate was up, and the dollar was up 4%, and the market was flat over that 6-month period. So after that big decline in Q4 of 2018, you can see crude oil also down with all these different equity asset classes. So we are hardly, even though since that October 8th low point now up until today, things have been looking really well, right? So if I go to October 8th, 2019, all the way up till now, you can see, if I hit OK here, that yeah, look at crude oil up 14%. Look at small cap stocks up 10% in a really short amount, just over 2 months. International stocks doing well, high yields up 1%. All of these asset classes, safe haven asset classes, all down. But you notice they're only down like 1% on gold and 5% on treasuries, after having been up 25% going into that low point over here on the left. So as I mentioned back over here in previous videos, you know, and also my classes at Market Scholars, right? What we have right now and what the market has going forward is this unwind of the safety trade that we are now going through. We are going through the unwind of a safety trade that was built up to such extremes because the market was expecting a recession. This trade issue, this trade spat with China to produce a recession that never came about. It would have been one of the most widely expected recessions in history, considering what the market was pricing in. And we never got that, and now we're unwinding. And again, this is all the unwinding so far that we got. Yes, equities are up 10%, 9% in a 2-month period, and that is a pretty decent return. But that's not euphoric, right? That's a much different scenario than, say, what we look like going into that. If I were to go back here, let's go to the market forecast chart. A lot of people are comparing this to January of 2018. Just to give you some context on that January 2018, let me go back a little bit further here. So you can see that last little move started here. Really, it kind of started in November of 2017. Then we had a 2-month return that spiked up, and this is what a lot of people now, what they need to do, honestly, is go to their charts and put on log scale, and then they would look at that and see, okay, yes, that was a lot more euphoric than this is. This just looks more euphoric because you're on a arithmetic scale instead of a log scale. So that's an issue. But the other issue too is if I were to come over here to, you know, let's go into that low point that we bounced off of in November, say about November the 17th, and let's go back to that same asset class comparison chart, but we're going to go 6 months into that November 17th. So remember, going into this October low point, this 2-month period that we're bouncing off of, October 17th of 18, no, of 17, and then we'll go to a 6-month period here, 6 month of 05, 18. That's 6 months. That should be 6 months. And let's do a day. Oh, and that would be 05/18 of 2017. Here we go. So this is that 6-month period going into that same time frame. And again, this is the time where I've been on record a lot, especially in our classes, saying we should have had an intermediate pullback here. But instead, because we already had a 3-month intermediate rally going on the market forecast chart, we should have had the intermediate line pullback, and we were starting it. But then the tax reform and everything, and the tax reform bill gets passed, or the expectation it will get passed, and then the implementation of it in the new tax year, and the market went through the roof for 2 more months. We had a 5-month-long intermediate run, and risk appetite went haywire. Well, this is that chart, again, going into that low point that started that euphoric 2-month run that a lot of people are comparing this 2-month run to. This is what the chart looked like going in. Very, very different than this chart where the excuse me, the safety trades were so bullish. Here, and remember, the market's been pretty bullish this year, and that's what the safety trade's done over that time frame. Not so in November of 2017, ahead of that 2-month euphoric run. And if I were to go to a year and do the same exact thing on a year chart, going into that same low point, you can see emerging markets are up 35%, and small cap stocks were up large cap up 17%. Dollars down, which is what's driving those international returns. But that was it, right? You see why, you know, we added on to those returns with a 2-month euphoric run. This is hardly the case, right? Again, this is the 1 year chart going into a low point that we had in stocks just 2 months ago. So there's a lot of unwinding left to go here, heading into, I believe, 2020, especially if there is a lack of uncertainty regarding the U.S. elections. No matter who wins, right? As long as the market knows who's going to win and can price it in with certainty instead of uncertainty, which causes volatility, then there's an opportunity for this unwind to continue into next year. And we're, with us hardly being euphoric at all. Now, a 9% return in 2 months is a big deal. So, it doesn't mean that we won't get a small pullback like we talked about before, but it's hardly euphoric, and it hardly means that we're going to all of a sudden start tanking here, like you saw here. That one of the other things I tweeted out here this evening was, now the markets have nothing to do with fundamentals. Well, that just means that person has been on the wrong side of the market. When you trade what you think the market should be doing, instead of actually viewing what it is doing, which is what we do in this video day after day after day. We view what the market is doing, base expectations, and adjust according to that. Then when you trade what you think it should be doing for whatever the reasons it should, then you end up blaming market manipulation more often than not, which is what this particular strategist is saying. If I were to do the exact same thing with the sector returns going into that November 2017 low that started the 2-month euphoric rally, utilities were up pretty decent, materials were there. Look at financials, strong returns they had. Technology was up 33%. Energy, of course, has been lagging for a long time. And then there's real estate and staples, your safety trades, all down here at the bottom. Healthcare also lagging behind, along with industrials. That was the picture going into that November 17th low points. Those big returns on technology. If I were to now go into this October 8th low point that we just had into 2019, and we'll go the same 1 year period, going into that October low point, right? You can see, look at the safe haven trades, all up 20%. Real estate and utilities, the interest rate sensitive sector, staples up over 10%, while the market was flat. And then all your cyclical areas like industrials and materials and healthcare and financials, and of course energy, all really lagging behind. This is hardly a euphoric market coming off of those lows. So the same idea is, we had a pretty big winding up of the safety trade because we were expecting a recession. At least a lot of people were pricing in a recession. And the reality is now most likely we're not going to get that. And, according to Fed expectations of Fed policy and now that a lot of these economic indicators, macroeconomic indicators are bottoming and have slowed their descent, will appear to be bottoming. Now it looks like those economic growth expectations will start to ramp up again, and inflation expectations will start to ramp up again, which will lead to an unwinding of the safety trade in the sector rotation as well. And that leads us to our trade idea of the day. And again, we've already put this trade on in the Market Outlook live session that I do at 3:30 Eastern times. You can catch it live too with that link I showed you on the market forecast page. All you have to do is be a Plus subscriber. $99 a month gets you access to all of our classes, all of our trading rooms. We do have 2 Q&A sessions for premium members, but that $99 a month gets you access to 8 weekly trading rooms, as well as that Market Outlook live video. But we did take a look here at PayPal. You can see PayPal breaking out a little bit here. You've got a you got dark green shading, green line. You got a strong market forecast posture. Market sentiment you see is crossing above 50. Very good sign from a long-term perspective. In fact, if you take a look at a 1-year chart, you can see the basing and a little bit of a inverse head and shoulders pattern developing with the breakout occurring right now. If you take a look at the 3 green arrow chart, it shouldn't be surprising that we have 3 green arrows on it now. In fact, this little basing pattern that we've had that produced that inverse head and shoulders pattern on a long-term chart basically got us to where we almost got a death cross. Almost. About as close as you can get to a death cross without actually producing a death cross. 11 hundredths, or about 12 hundredths of a point. If you can see over on the left, that number there. So about as close as you can get without getting it. But now you can see the PPO is rising up again. The last time we did that this was actually a lot closer, but the last time we had this type of move and this type of breakout, we had a good long multi-month run at the beginning of the year, and very well could get the similar type move right now according to past precedent. You can see when you look at the Bollinger Bands for PayPal, you can see we crossed up above the upper Bollinger Band today. So kind of the second time we've done that recently, after breaking above the point of control, coming down, retesting it, bouncing off of it, and breaking out above this volume node. You can see very little volume going forward from here. Path of least resistance is easily to the upside, a lot more than it is to the downside. Looking at some of these other kind of trend charts that we look at, you're above the Ichimoku cloud. You're back. We were below the blue line on the pullback, above the cloud but below the blue line. We bounced back up the last 4 days, getting us a trend developing. It's still weak at these levels, but it's a trend that's developing here. Then you look at the DMI, and what's interesting about the DMI chart here is the ADX is way below 10, which means it's been so flat for so long. You know, there's a little bit of a breakout move. It's due for a breakout move according to the ADX. So what we did on this stock is we went to, well, let's take a look. One more chart is the 3 green arrow chart here on this chart, and you can see how the MACD is and the stochastics both crossing above their moving averages and rising up again. So very, very bullish patterns all across the board. So what we did with PayPal is we said, okay, well, let's go out to March. We got earnings coming up. That's okay. We'll go out to March. We'll buy the at the money with a 50% stop order. So we just right click, hit buy custom with stop. We buy at the money. I think we bought at 555 is where we got into it. It's at 565 now with a stop order at half of that, and we position size for a full position because it's got a good chart. It's more of a swing, a trend type of trade here. Swing trade to begin with, and if it continues this breakout, we'll just let it keep running and try to get as much return as possible. If you take a look at the trades that we have here, let's get rid of this simulated trade. But if you take a look by March, by expiration day, if we were to get up towards 122, which is 1 standard deviation away, that's back up to these old highs. If we were just to get up there and remember, there's no resistance here. Very, very little resistance from a volume standpoint. Then we're looking at about a $2,000 return at expiration, and of course we can always just roll that and let it keep running if we were to get up to those levels, because as we saw the last time we had a near death cross that turned into a bounce and breakout. It led to a multi-month run, more than just a few months, like we have set up for here. All right, well, that does it for today. Now you've heard from me. I want to hear from you. Use that link right there. It takes you to our Market Scholars website, to our Market Outlook forum. You have to be a subscribed member, but you can do that for free, as I showed you before. But let's keep this conversation going. So if you have any comments or any reactions to anything I talked about today in the video, let me hear about it, and let's reply to anybody else's reactions that you see in that community as well. That's the whole point of a forum, right? So we can have some conversations and back and forth with other members of our Market Scholars community, other Market Outlook viewers on a day-to-day basis. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content in between the videos, and join our community on our website as well as our Facebook group that we created. Have a great rest of your evening, everybody, and we'll see you all next time.